Friends, let me now talk to you about financial management, exclusively on financial management in more detail. See, the financial management, it is that managerial activity which is concerned with the planning and controlling of the firm's financial resources. So, in simple words, finance function in a business is the task of providing funds needed by the organization on terms that are more favorable to the objectives of the organization. And this financial management also covers the legal and accounting relationships between the organization and its source of funds. And finance function is certainly broader than that of the fund procurement or supply. So, the more acceptable definition or approach, it envisages that finance function is a function which is connected with the procurement of funds and the effective utilization in the activities of the organization. So this approach, it warrants a decision making after analyzing the alternative uses and the source of funds. So a financial manager, he has to play a major role in planning of the business concerns the need for funds, raising the necessary funds, putting them to the effective use, finalization of the accounts as per set accounting standards, meeting the requirements of the government, meeting the requirement of the owners, the investors, financial institutions, meeting the requirement of the lenders and the creditors. So, in this sense, finance functions cover financial planning, forecasting of the cash receipts and disbursements, realizing of funds, the use and allocation of funds, and the financial control through the rules, regulations, delegation, budget, and other types of financial control. So, a financial manager, he attempts to bring performance closer to the targets. So, all the important activities of the organization, namely the production, personnel, and marketing, they are closely associated with the finance functions because without finance, without money, no activity can be carried out. So the firm secures the capital it needs through various sources and it employs it and generates the returns on the capital invested through production and marketing activities. So the firm expects to receive the returns on the investment over a period of time and periodically distributes the returns on the investments to the investors, to the government, as the case may be. So these processes, they are not sequential, they are performed simultaneously and continuously also. So almost all activities of an organization, directly or indirectly, involve the acquisition and use of money, whether it is recruitment and promotion, whether it is buying a new mission or sales promotion policy. So there exists an inseparable relation between the finance function and all other functions of the organization. So an organization in a tight financial position, it will give more weight to the finance consideration and it will devise its marketing and production strategies in the light of the financial function constraints. That is, should an organization commit the capital funds to a certain purpose? Are the expected returns adequate to compensate the cost and the risk attached to the additional capital? How does the cost of capital vary with the mixture of financing method that you are deploying, you are using? So all fall under the broader scope of financial function. So the broader scope of finance function further includes also the judgments about whether a company should hold, reduce, or increase the investment in various assets. So this in turn requires a definable basis to hold, to reduce, or increase the investment in various assets. So this in turn It requires a definable basis to answer the following three questions: a justifiable basis, a justifiable reason. So, what specific assets should a company require? Number two, what total volume of funds should a company commit? How should funds required be raised? So, these three questions are closely interrelated, and the finance functions they are concerned with almost all aspects of business operations. However, a fairly lot of business decisions do not involve the changes in the volume of funds to be used. So these lie outside the orbit of the finance function, though they may be affecting the profitability of the business. So these decisions may be termed as the technical or the non-financial decisions, like number one, the decisions about the labor's participation in management, decisions about the changes in employment practices, the change in marketing and advertisement technique. So finance functions they are broadly classified into the two types, namely the managerial finance function and the non-managerial finance function. Managerial functions like those which require the skillful planning, control and execution of the financial activities like investment decision, the financing decision to acquire or dispose of the assets, and to require the commitment or recommitment on a continuous basis. So finance functions are set to influence the production, marketing, and the other functions also. So this, in consequence, it will affect the size, the growth, the possibility and risk of the firm, and ultimately the value of the firm. So routine finance functions do not require any great managerial ability to carry them out. So like the supervision of the cash receipts and the payments, safeguarding of the cash balances, the custody and safeguarding of the securities, the insurance policies, and other valuable papers, taking care of the mechanical details, record keeping and reporting, finalization of the accounts, etc. So the financial objective, it provides a framework for the optimum financial decision making. So in other words, they are concerned with designing a method of operating the internal investment and financing of an organization. So a firm has to make at least three fundamental decisions. So it must determine whether to invest funds and in what amount, in what quantum, how much to pay in dividends, where to raise the funds and in what quantum or what quantity, in what amount. So these decisions relate to the firm's investment and financing policies. So the financial decisions, they are unavoidable and they are continuous also. So in order to make them rationally, the firm must have an objective, and it is generally agreed that the financial objective of the organization should be the maximization of the owner's economic welfare or the government's economic welfare, and not the profit maximization. So, in other words, it is wealth maximization and not the profit maximization. So, the investment decision of an organization, it therefore relates to the selection of assets in which the funds will be invested by the organization. The assets that can be acquired fall into two broad groups, namely the long-term assets that yield a return over a period of time, or it may be short-term or current assets, defined as those assets which in the normal course of business or they are convertible into the cash usually within a year. So the asset selection decision of a firm, again it is of two types. So the first category of the assets, it is popularly known as the capital budgeting. So this is the first of these two types. And while that relating to the second category pertaining to the current assets, it is known as the working capital management. So the capital budgeting and the working capital management. So most crucial financial decisions in a firm relate to the selection of an asset or investment proposal whose benefits are likely to be available in future over the lifetime of the product. So the selection of the new assets, it relates to the choice of the few alternatives that are available. So whether the asset will be accepted or not will depend upon the relative benefits and returns associated with the asset or the investment proposal. So they have to be estimated under various assumptions of the physical volume of the sale and also the level of prices, an element of risk in the sense of uncertainty of future benefit. It is thus involved in this exercise also. So the return from the capital budgeting decision, it should therefore be evaluated in relation to the risk associated with that. So the evaluation of the worth of a long-term project implies a certain norm and standard against which the benefits are to be judged. So the different norms, they are known by different names such as the cutoff rate, bundle rate, required rate, minimum rate of return, and so on. So this standard is broadly expressed in terms of the cost of the capital. So working capital management, it is concerned with the management of the current assets. So it forms an important and integral part of financial management, as the short-term survival is prerequisite to the long-term success. So one aspect of the working capital management is the trade-off between the profitability and the risk, that is liquidity. So the key strategies and the considerations in ensuring a trade-off between profitability and liquidity is one major dimension of the working capital management. So the management of working capital, it has again two basic ingredients, namely uh, a an overview of working capital management as a whole, and B, effective management of individual current assets. So let us see the financing decision, the investment decision or the financing decision. It is broadly concerned with the asset mix or the composition of the assets of a firm. So the concern of the financing decision is with the financing mix or the capital structure or the leverage. So the term capital structure, it refers to the proportions of debt and equity capital. So the financial decisions of a firm relate to the choice of the properties of these two sources to finance the investment requirements. So there are two aspects of financing decisions. Theoretically, the capital structure shows the theoretical relationship between the employment of the debt and the return of the investors. The use of the debt implies a higher return to the investors. So any loan, long-term loan, it implies a higher return to the investors, as also the financial risk. So a proper balance between the debt and equity to ensure trade-off between risk and return of the investor or the government is necessary. So that is the decision that a financial manager has to take, and that forms the most important part of the financial management. So coming to the dividend policy decision also. So the dividend decision, it should be analyzed in relation to the financing decision of the firm. So two alternatives available in dealing with the profits of the firm are that they can be distributed to the investors in the form of dividend, or they can be retained in the business for some more time. Then how long, that also is to be decided. So one significant element in the dividend decision is therefore it is dividend payout ratio. So that is what proportion of net profit should be paid out to the shareholders. So these decisions will depend again upon the preferences to the investors and the investment opportunities available within the firm. So there comes the financial analysis. So it's also a very important part of the financial management. So financial analysis means analyzing the financial position, liquidity position, performance of the organization, the company or the government department, the commercial department over a given period of time, the capital investments, vis-a-vis the sources of funds, major commitments, utilization of the scarce reserves, the profits earned, vis-a-vis capital employed, adequacy of working capital, whether capable of repaying the debts, sources available for the expansion, the business trend, capital gearing, etc. So all these forms the part of this exercise, and the tools of financial analysis. They are one, the comparative financial statements, common size financial statements, the trend analysis, ratio analysis, fund flow analysis, etc., etc. And all these forms are part of the financial management. Thank you, friends.